Hi, today I'm going to explain about the question for past years in October 2016 and also in March 2016. So first of all, I'm going to start with March 2016, question 2A. So first of all, I'm going to read the question. That is, an actuary is recognized as a professional with special privilege and responsibilities. The actuarial work always occurs within a context or environment that is made up of a diverse and intricate array of elements. Briefly discuss these elements below in the context of actuarial work. First of all is taxation, and the next one is economic trends. So I'm going to start with taxation. Okay, taxation is nearly always part of context for actuarial work. So it means that it's very important for the actuary. It actually can affect product pricing, valuing policy or scheme liabilities, determining profit, analyzing expenses, projecting likely future cash flows, and financial institutions are subject to the taxation regimes of the countries or states in which they operate. So whenever they operate in the country, they will have to pay the tax, as we call the revenue for the country, for the government. For actuary, they should be aware of future changes to the taxation regime, so it's important to them. So taxation can affect product pricing and so on. So that's why it is important to actuary. So moving on to economic and trends. So economic and trends will influence the choice of assumptions. All clients are often financial institutions or schemes whose future experience will be greatly affected by economic condition and their changes over time. So these are the examples: saving products and salary inflation for defined benefit pension schemes. Insurance claims are significantly affected by economic factors. Changing in demand and supply conditions affect prices of goods and services, which influence the cost of the insurer of claims for repair or replacement of damaged or stolen property. Exchange rate movement can affect the cost of claims on property insurance policies. So these two are the elements of context of actuarial work. So we continue to question B, that is, define and explain the following items. So first of all is life insurance, and then takaful, and then reinsurance, and then investment, and the last one is superannuation. So I'm going to start with life insurance. Okay, life insurance generally provides a cash lump sum. The sum insured in the event of death of the life insured. In the case of joint life policies, payment can be made on the death of either the first to die or the last to die. Life insurance comes in a range at different packages of cover, investment and additional options. Okay, so that's for the life insurance, and continue to takaful. So takaful is a type of Islamic insurance where members contribute money into a pool system to guarantee each other against loss or damage. So the money they share between each other, and all parties in takaful agree to guarantee each other and make contributions to a pool or mutual fund instead of paying premiums. So they use the pool system rather than paying the premiums. Okay, the pools of collected contributions create a takaful fund. Each participant's contribution is based on the types of coverage they require and their personal circumstances. And a takaful contract specifies the nature of the risks and the length of coverage, similar to that the conventional insurance policy. Okay, that's for takaful. And we move to reinsurance. Okay, reinsurance is insurance that is purchased by an insurance company. Reinsurance is bigger than insurance company. in which same parts of its own insurance liabilities is passed on to another insurance company. The company that purchases the reinsurance policy is called a ceding company. So those who buy the reinsurance policy is called a ceding company. The company issuing the reinsurance policy is referred simply as the reinsurer. So reinsurance allows insurance company to remain soft after a major claims event. The major claims events such as hurricane, or maybe something that happened to the catastrophe loss, like an event of lots of loss happen. And then moving on to investment. Okay, investments means that an asset is bought or that money is put into a bank to get a future interest from it. Investment is total amount of money spent by a shareholder in buying shares of a company. In economic management sciences, investments means longer term saving, because it has the future interest from it. We can gain the future interest. Okay, next, the last one is superannuation. Superannuation is an organizational pension program created by a company from the benefit of its employee. It is also referred to as a company pension plan. Fund deposited in a superannuation account will grow, typically without any tax implication, until retirement or withdrawal. In the United States, superannuation plans are usually either defined benefits or defined contribution plans. So, okay, we finished for March 2016. Okay, now we're going to continue with October 2016. Okay, so now I'm going to discuss question 2A, October 2016. I'm going to read the instruction. Briefly discuss the income tax exemption provided by the government of Malaysia in order to encourage personal saving behavior during working lifetime for retirement among its citizens. So, income tax exemption mean that taxpayers in Malaysia are not taxed on total income, as certain portions of the income are tax exempted. For income tax filed in Malaysia, we are entitled to certain tax exemptions that can reduce overall chargeable income. Tax exemptions either reduce or entirely eliminate our obligation. Most taxpayers are entitled to an exemption on their tax return that reduce tax bill to an exemption on reduce the tax bill in the same way a deduction does. So this what does the tax exemption does by the government. So I'm going to move to question B. Question B, briefly discuss the characteristic of any two social security benefit programs as provided by the government of Malaysia. Social security is provided in Malaysia by SOCSO, the Social Security Organisation. At the same time, the Employment Provident Fund, EPF, which are predominantly for retirement purposes. The contribution to both schemes, the SOCSO and the EPF, are compulsory. This means every employee and employer is obliged to pay a certain amount of employees' monthly wage into these funds. Here is the two social security benefit programs in Malaysia. First of all is the disability benefit from SOCSO and the retirement benefit from the EPF. So the SOCSO offer two insurance schemes. First of all, the employment injuries insurance scheme. The rate of the employer's contribution is 1.75% of the employee's monthly wage for both schemes, while the worker contributes 0.5% to invalidity insurance scheme only. So also covers industrial accidents, occupational diseases, accidents, invalidity or death. Further benefits including further specific benefits. So the Employment Provident Fund, EPF, was initially introduced as a savings for specific purposes like house ownership and medical purposes. The employer pays a contribution rate of 12% of the worker's monthly rate, while the employees contribute 11%. So that's the answer. I think that's all from me. Thank you for watching.